Guest is Scott Minerd. He manages $100 billion as the chief investment officer for Guggenheim Partners. Scott Minerd previously working as managing director for Morgan Stanley and at Credit Suisse. He joins us from Los Angeles. Scott Minerd, this whole idea of economic stimulus coming from the Federal Reserve in the form of lower interest rates, what does that do for treasuries right now? We know that you're not getting a lot if you want to lend your money to the government.
Right. Well, Pimm, I think with the likelihood that the Fed is, going to have to dive back in with some quantitative easing, I think we have a ceiling on interest rates. And I think that the risk to interest rates is not that they'll suddenly go higher, but that we could move meaningfully lower from where we are today. I've been bullish for a while, you know that, and I'd like to declare victory and go home at 2.5% on 10-year notes. But the reality is that we may see treasuries at 2% or lower, and that could happen before the end of the year.
2% or lower for a 10-year U.S. Treasury bond.
Right.
And what would cause that? More stagnation in the economy? What would cause the interest rates to fall?
I think that it's going to be one of two things. Either the economy is going to continue to bounce along here at the bottom, which I think is very likely under any set of circumstances. We're an economy flying at minimum speed. I don't think that we're going to go into a recession or crash, but I think we will buzz the tower. And because of concerns about recession, I think, and paralysis on the policy side in Washington, the Fed will get forced into another round of quantitative easing, and that will push rates lower. If they don't move in, the risk of recession will increase and rates will move lower because of a risk of recession. So either way, whether they step in or they don't, I think long-term rates are going to probably still move down another 20% from where we currently are.
All right, Scott Minerd, we want you to be our co-pilot a little bit. Help us understand and how to navigate this situation. What kinds of investments would do well in addition to, as you just described, treasuries? If yields are going down, those prices are going up. What other things should we be buying?
Pimm, there's a lot of short duration, high yield bonds out there that where the companies have plenty of liquidity, more than sufficient to repay the debt that's coming due in the next 2 to 3 years. Those have very attractive returns between 8 to 10%. I would go there. The other place I think is to go into what I call the anti-currency trade. That's gold, it's silver, collectibles, and of course even industrial metals, because I think once we get into the mode of quantitative easing and we get into the first half of next year, there will be some kind of a policy response, and any kind of pickup in economic activity will cause these things to go up in price.
Scott Minerd, when you talk about collectibles, what kinds of things do you mean? Are you talking about art? Do you talk about coins or things that have other types of value, intrinsic value? For example, maybe even real estate, expensive homes.
Well, I think it's a little early to be jumping on the real estate trade. Though homes are very, very affordable and very cheap at these levels, but the overhang in inventory and housing, Pimm, will probably keep prices down for at least another 5 years in real estate. A Picasso like the one you have could be very attractive. The last one I saw. No, that was a joke.
No. I'm glad. I thought that's what you're going to give me for Christmas, so I'm just counting on it, Scott Minerd.
But there are some other interesting stuff out there. For instance, on this show I've mentioned before, as the baby boom ages, there's interest in rock and roll memorabilia. And, collectible guitars have done very well over the last 5 years and probably will in the future.
Do you think, though, that this idea of collectibles is something that people can use to bank on for at least part of their retirement? In other words, if you're, let's say, in your 20s or 30s, start collecting what's popular now, because for sure in the future it's actually going to hold its value.
Well, I think, Pimm, that if it's done well, and this is where I would say you should get a professional who's very good in the area to work with, in the area of collectibles like art or memorabilia. This sort of stuff is going to hold its value over the long period of time, more so than financial assets. And so good, prudent investments today in art and collectibles will probably outperform bonds and perhaps even equities over the next 20 to 30 years. So as an asset class, I think everybody everybody should be allocated there to some degree.
Scott Minor, do we get any kind of signal when it's okay to start buying equities again?
I think that, quantitative easing has shown to be good for equities. When we got quantitative easing in Japan, that was the beginning of the bull market for the Nikkei. When quantitative easing ended, equity prices started to stall out and fall. We had a very similar experience in this country. When quantitative easing got started, equity prices took off. Once the Fed stopped expanding the size of its balance sheet, equity prices have stalled out and have begun to decline. So I think once we get the Fed back in the game of buying Treasury securities, it'll be a green light for equities, and it'll be probably time, Pimm, to move away from fixed income and back into equities.
All right, we're going to leave it there, but I want to thank you very much, Scott Minor, coming to us from Guggenheim Partners. I'll make a deal with you, Scott. You get me the Picasso, I'll buy you the Stratocaster, all right?
I got to pick out the good Stratocaster.
All right, you do that. All right, I want to thank you very much, Scott Minor, sharing your insights with us.